Taking a look at the industry regulation, after the 2008 financial crisis, the G20 identified that systemic risk that could potentially be from hedge funds need to be regulated, and since South Africa is part of the G20, they also had to commit to introduce hedge funds regulation to monitor the potential systemic risk that it introduces to the overall market. The Financial Services Board then started engaging with the overall industry to see where the regulations should fit in. It made the most sense because most hedge funds in South Africa is managed as pooled investor funds, so it made the most sense to align it with the very well-known regulation of the collective investment schemes in securities. That encompasses the unit trust environment that already has more than 2 trillion rand under management. They then introduced 2 pillars under the regulation: a collective investment schemes in retail hedge funds and a collective investment schemes in qualified hedge funds. As the name implies, the collective investment schemes in retail hedge fund will be open to the general public, and they can also invest into these respective products, opening up a whole new revenue or a whole new inflow for asset managers. Collective investment schemes in qualified hedge funds will be only open to qualified investors, and the regulations made it very clear a minimum of R1 million, so more open to institutional type of investors. So what we've seen over the last year is some of these funds starting to transition to this new regulation. Some of the new requirements that weren't in place in the past is they would require the services of a management company. So most of the South African hedge fund managers have entered into a co-naming agreement with established management companies. They'll also require the services of trustees, administrators, completely aligning the industry with the collective investment schemes and securities industry. Some of the benefits that's included by the regulation, and the main focus from the regulator's point of view, is investor protection, to ensure that capital is safeguarded and is in a uniform structure. So as an investor enters this product, yes, they might have different managers that manages money differently, but they know it's a uniform structure. There's several oversight functions in the form of trustees, in the Financial Services Board, form of a management company, the list goes on, and their money is safeguarded from any wrongdoing.